Passive income from dividends? Join me as we analyze some dividend-paying stocks together. In 2024, the market continues to be propelled upwards by big tech companies, which means we can find good entry points for cheap yet quality dividend-paying stocks. Hello everyone. This is the Financial Freedom Channel. In today's video, we're going to take a look at 3 stocks that may be worth considering. High initial dividend yield, Blue All Capital Corporation. Medium initial dividend yield, medium dividend growth, Chevron Corporation. Low initial dividend yield, high dividend growth, NextEra Energy. OBDC, dividend yield, 9.48%. Dividend safety score, 50, borderline safe. Last dividend growth, 6.1%, average, market cap, $5.76 billion, mid-cap. About OBDC, Blue All Capital is a business development company specializing in direct and fund-of-fund investments. It invests in various types of loans, equity-related securities, and preferred equity investments within private equity, targeting middle market and upper middle market companies in the United States. Their investment criteria include companies with EBITDA between $10 million and $250 million annually and/or annual revenue of $50 million and $2.5 billion at the time of investment, with typical investment sizes ranging between $20 million and $250 million and maturities between 3 and 10 years. Currently, there is a low payout ratio, which is reassuring, although the net debt is quite high. There was a dividend cut recently, and dividends are not increased every year, but with the high initial dividend yield, I don't think this is expected anyway. Low PE ratio. Earnings payout ratio. For BDC companies, the expectation is to keep the earning payout ratio below 95%. The free cash flow payout ratio is highly volatile, so I don't usually take this into account. Earnings per share has shown a growing trend in recent years, which is good to see. A 4% increase is expected for this year, which isn't too much. Shares outstanding. It's characteristic for BDC companies to issue more shares over time, but total sales also grow steadily year by year, so there's no issue with that. Return on equity and return on invested capital have looked good in the past 12 months, but of course, this doesn't guarantee that this year will be equally good. Let's look at the debt, which is crucial for dividend security. The preference would be below 0.4. OBDC has been consistently above this for 4 years, but I think the level of debt is still manageable. The interest coverage doesn't look too good over the past few years.
Current price, $14.77. 1Y target, $15.68. $14 seems like a good entry point to me, but it's important to note that this video does not constitute investment advice.
The next stock we're going to look at is Chevron. Chevron, dividend yield, 4.33%. Dividend safety score, 90, very safe. Last dividend growth, 7.9%, average. Market cap, $283 billion, megacap. About Chevron, Chevron Corporation, through its subsidiaries, engages in the integrated energy and chemicals operations in the United States and internationally. The company operates in 2 segments, upstream and downstream. The upstream segment is involved in the exploration, development, production, and transportation of crude oil and natural gas, liquefaction, transportation, and regasification associated with liquefied natural gas, transportation of crude oil through pipelines, and processing, transportation, storage, and marketing of natural gas, as well as a gas-to-liquids plant. The downstream segment refines crude oil into petroleum products, markets crude oil, refined products, and lubricants, manufactures and markets renewable fuels, transports crude oil and refined products by pipeline, marine vessel, motor equipment, and rail car, and manufactures and markets commodity petrochemicals, plastics for industrial uses, and fuel and lubricant additives. Currently, there is a relatively high payout ratio and very low debt. Dividend growth streak, 36 years, sector median 1 years. Uninterrupted dividend streak, 112 years, sector median 4 years. Based on dividend yield and PE ratio, $150.60 seems like a fair price. The earnings payout ratio seems a bit high, as does the free cash flow payout ratio.
Earnings per share and free cash flow per share have both been able to grow over the past 10 years. Earnings per share growth and sales growth have been quite volatile, but this is typical for companies like Chevron. Shares outstanding have decreased slightly, while total sales have been able to grow modestly over the past 10 years. Return on equity and return on invested capital have consistently been above expectations over the past 4 years, similar to the operating and free cash flow margin. As mentioned earlier, the debt is very low, which is important for dividend security, and the interest coverage has been consistently above expectations for years. Current price, $150.60. 1Y target, $176.87. I think it could be a good entry point, but it's important to note that this video does not constitute investment advice. The next stock we're going to look at is NEE. NEE, dividend yield, 3.38%. Dividend safety score, 90, very safe. Last dividend growth, 10%, fast. Market cap, 113 billion, mega cap. About NEE. NextEra Energy generates, transmits, distributes, and sells electric power to retail and wholesale customers in North America. The company generates electricity through wind, solar, nuclear, coal, and natural gas facilities. It also develops, constructs, and operates long-term contracted assets that consists of clean energy solutions, such as renewable generation facilities, battery storage projects, and electric transmission facilities, sells energy commodities, and owns, develops, constructs, manages and operates electric generation facilities in wholesale energy markets. As of December 31, 2022, the company had approximately 32,100 megawatts of net generating capacity, approximately 88,000 circuit miles of transmission and distribution lines, and 871 substations. It serves approximately 12 million people through approximately 5.8 million customer accounts in the east and lower west coasts of Florida. The company was formerly known as FPL Group and changed its name to NextEra Energy in 2010. NextEra Energy was founded in 1925 and is headquartered in Juno Beach, Florida. Currently, there is a low payout ratio and low debt, which is very important for stable dividend payment and growth as well. Dividend growth streak, 28 years, sector median 12 years. Uninterrupted dividend streak, 28 years, sector median 24 years. Based on dividend yield and PE ratio, the company appears to be undervalued. It's good to see that the payout ratio has remained steadily below 75%. Earnings per share increases year by year. Shares outstanding are increasing, but this is usually the case for similar companies. However, it's important that total sales grow alongside it. Return on equity and return on invested capital can be considered average. Operating margin is growing nicely, which is good to see. Debt doesn't seem excessive, and interest coverage can be considered average. Current price, $55.25. 1Y target, $73.22. I think it could be a good entry point, but it's important to note that this video does not constitute investment advice. Thank you for watching the video. If you don't want to miss similar content, subscribe. Please comment below which stocks you'd like us to review next. Hello everyone.